Stocks rallied for their fourth straight day to close this holiday shortened week, as we got a little bit of good news this morning from the June employment report. We did see the NASDAQ hit an all-time high. We also have some lagging in a little bit of the small cap area and the Dow Jones Industrial Average from a posture perspective, but the NASDAQ remains our leader with a strongly bullish posture to the upside. Of course, no trading tomorrow in recognition of the 4th of July holiday here in the United States, so this will be the last video of the week, and then we'll get going again next week. So let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's July 2nd, 2020. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe, check out our description area, sign up for our email distribution list. Additionally, we have a heavy presence on Twitter. Make sure you're following me at Brandon Van Zee, and we would encourage you to click like and retweet on our Market Outlook related tweets if you would like to see these posted as often as possible. Lastly, we have a presence on Facebook as well. Feel free to join our group at the web address you see embedded in that logo in front of you. All right, let's go ahead and jump into our charts here. And as you can see, I've got chart 4B pulled up here in front of us. This will give us a good bird's eye view of the four major stock market indices here in the United States. And we have some differences this time around. Remember, a lot of times stocks tend to track one another, regardless of whether it's small cap versus large cap, or whether it's technology or industrials or what have you. But right now we actually have some differences to discuss. So first of all, what I mentioned in the intro, which is in the lower left-hand corner here, you'll see that the NASDAQ composite was up 0.52% today, and at one point today touched a new all-time high of 10,310 on the NASDAQ composite. You can see here the background color of this chart is this dark green color, which suggests we have a strongly bullish posture on the NASDAQ itself. You can see the NASDAQ's intermediate line that we use to determine that bullish posture is at 82 and rising. Remember, anything above 80 on the market forecast would be considered bullish territory. So this is clearly the leadership area. As I mentioned on Tuesday, momentum stocks in general have been doing quite well. So if you combine momentum and NASDAQ composite types of stocks, oftentimes technology oriented, you've had some very strong performers out there. In fact, I just got done posting here not too long ago on Twitter. For those of you that follow me there, I said it's double day for our top-down trend trading position in DocuSign at Market Scholar. So that's my Monday top-down trend trading class for those of you that attend that. We've made 111% in about, what was it? Checks notes, 2.5 months. So I think most of you recognize that is not a normal occurrence, but that is in fact the truth. I think we bought that on April 13th, and we're already up 111%. So very peculiar things are happening in this market, but you do have to be in it to win it at the same time. Obviously, there's been a lot of nervousness out there regarding stocks generally because of how the economy has been kind of slow to get back to its normal, pre-COVID kind of environment. But in the meantime, there are certain patches of the stock market that are rallying furiously. And if you've been in the technology space, especially with some of those work-from-home types of stocks that happen to be part of the momentum cohort on the NASDAQ composite, you've actually had some spectacular results in some cases out there. So anyway, we've mentioned this time and time again, but sometimes you need that repetition just to hammer it home. Our leadership area of this market right now is technology. And remember, technology was also the leading sector on my sector selector rankings last weekend. I'll plan on doing that here probably tomorrow for the new rankings, but at this point I anticipate that technology will remain number one given what we've seen this week. Now, in terms of the S&P 500 itself, which of course is more widely tracked from a benchmark perspective than the NASDAQ, we had a good performance there today as well. We were up 0.45%. However, you'll notice that we closed well off the highs there, and in doing so, we actually flipped back to a weekly bearish posture. So we had that bullish posture for one day, where we have that little green sliver on the chart there, and then today we're back to this light pink sliver. When we look at the green line itself, from a visual perspective, it looks like it's pretty much just tracking sideways. So I don't know if I'd make too much out of this light pink shading. Now, one thing I did want to address is what I mentioned on Tuesday in this video, and what I mentioned last week as well a couple of different times on Twitter. Remember that the days immediately leading up to the 4th of July holiday have traditionally been quite strong from a seasonality perspective. There's been a lot of consistency. It's not just that the numbers themselves have been strong, but it's been the consistency of those numbers. I shared with you those statistics in Tuesday's video regarding, how many of those 3-day periods before the 4th of July were positive, and I think it was something like in the last 22 years, it was like 19 of them were positive, and only like 3 of them were negative, something along those lines. So that held true very nicely this year, and a little nugget like that, a little statistic like that, isn't necessarily going to guarantee your success. But if you were kind of sitting on the fence a week ago and trying to determine, should I place this bullish trade or not, that might have been just the statistic to push you over the edge and actually help you give the confidence to place that bullish trade. Now, of course, this year, you probably would have done quite well with that decision, as we have had 4 straight days, Monday, Tuesday, Wednesday, and Thursday, all positive gains for the stock market here. We remain above a rising 30-day moving average for the S&P 500. And we also remain above the rising 30-day moving average for the Russell 2000, which also has that light pink background color. So, in other words, weekly bearish from a posture perspective, using that intermediate line on the market forecast. But one difference we do have here is now looking at the Dow Jones Industrial Average. Now, it was up today as well. It was up 0.36%. But again, like a lot of the other indices, we finished well off the highs. You'll notice that pattern down below here with the Russell 2000 as well. We have those long upper shadows or upper candle wicks, however you want to state that. That's generally not perceived to be all that bullish. So while the end result of today was bullish, where we had positive gains across the board, we did not close near the highs of the session on most of these indices, and that kind of leads us into the weekend with a little bit more of a bearish feel than we would have had if we would have closed near the highs. So we have to keep that in the back of our mind. It's also worth remembering that the third quarter of the year is traditionally the weakest of the year. Now, July itself traditionally is not all that bad. When we're looking at the third quarter, which is made up of July, August, and September, it's usually August and September that come with the most bearishness of that quarterly period. Nonetheless, it is worth kind of thinking about that in advance. We've had an awfully strong run in the stock market here in the last, let's call it 4 months or so. And if we have a stumbling block or two in regards to, the coronavirus or the COVID-19. And remember, we had the highest amount of reported cases here today. I think it was like 50,000 cases that were reported, new cases reported in the United States today. We don't know when that's going to come back and bite us. Right now, we've been thankful that the mortality rates, death rates, and so on have not been quite as bad as what we initially saw in some places like New York. But nonetheless, we still have this problem that we're dealing with. And you look at the stock market charts and you think that there's no problem out there. But there is still a problem. And we don't know when that's going to come back and haunt you in the economy as well. So the Dow Jones is worth pointing out in this instance because not only is its background color of its chart different than all the other 3 charts, because now we have this dark pink shade of color here. That signifies strongly bearish posture. That occurs when the green line crosses below 50 and is trending lower. And you can see on the Dow Jones Industrial Average, the intermediate line is at 48 and falling. In other words, it's fallen through 50 and it continues to fall. So now we have this strongly bearish posture on the Dow Jones Industrial Average, and you'll also notice another difference on this chart compared to the other 3, which is the moving average color. Notice that the moving average color is yellow in this case right here, as opposed to green on all of these other charts that you see. When you have a yellow 30-day moving average on this particular chart 4B, that can signal or signify one of two things. It basically is indecision. Green is pretty obvious. It's when price is above a rising moving average. Red is pretty obvious because it's when price is below a falling moving average. Yellow is a conflict. You can think of it as kind of a yield sign if you're thinking about, red as stop and green as go and yellow as yield, as in the traditional traffic signs. So what this is signifying here is that price is now below a rising moving average in this case. So those are two things that are conflicting with one another. On the one hand, price is below the moving average. On the other hand, the moving average itself is still rising. So that is one way you can get a yellow moving average. Another way is the opposite of that. Like over here on the Dow Jones back in April time period, mid-April. You can see that the moving average was yellow back here for a spell as well. And that occurred when the moving average was going down. So remember, right now the moving average is going up. Over here, the moving average was going down, but price was above it. So again, conflicting signals there. Price is above a moving average, but the moving average itself is going down. You usually want those two things in conjunction with one another, but anytime there's going to be any sort of reversion to the mean or a trend change or something along those lines, it's usually going to start with that kind of yellow process that takes place right there. Now remember, not every yellow moving average will lead to a trend reversal. Sometimes it just needs a little bit of time to figure it out and it's back up there confirming the previous trend. But if there is ever going to be a reversal, there will be a yellow line involved, and so it is worth pointing out that that's where we stand right now. So we'll keep our eye on it. Again, we don't want to make too much of it, right? This market is basically sitting right here on the moving average, so it's not like it's breaking major support levels. But if it started breaking major support levels, let's say in the next few weeks, and we looked back at this on August 1st, we might say to ourselves, yeah, it might have been worth paying attention to the fact that we were getting some of those early signals there and maybe starting to lighten up some of our Dow Jones positions, or maybe even taking a couple of bearish trades here or there, considering most of you probably have largely bullish portfolios right now. Taking a few bearish trades in maybe some of those mega cap stocks could make some sense there. All right, let's go ahead and take a look now at the 1040 crossover method chart, and that will be here on chart 4C. So as we're looking at this, you can see that we still have the two crossovers that I addressed on Tuesday to the bullish side, and that would be the S&P 500, which gave us a crossover here a couple of weeks back, and then we also have the continued bullish crossover on the NASDAQ Composite, which took place way back in the first week of May. So that's been obvious. This, as I mentioned before, without a doubt, NASDAQ Composite's been the leader. So as that market continues to go up, we continue to get further and further separation between the orange and the blue line. For those of you that are newer to this video, be aware that the orange line here represents the 10-week moving average. The blue line represents the 40-week moving average. And when you see that wider separation like that, it's usually a positive sign for risk appetite, because it's basically saying that the more recent price activity has been so strong that the more lagging moving average is having a hard time keeping up with the more sensitive moving average in the shorter term. So we like to see that separation whenever possible. So we have a lot of separation there on the NASDAQ Composite. We have very little separation there on the S&P 500. So naturally that would be the one that would be closer to a failure zone if the market does roll over here. The market could roll over here for the next month or two, and theoretically the NASDAQ could still stay with a bullish crossover here for some time, because these lines do move quite slowly, since these are weekly candles that we're looking at here. Now on the other two charts, the Dow Jones and the Russell 2000, you'll notice we still have that pink shading here, which signifies that we have bearish crossovers there, or death crosses for some of you that might refer to it that way. And of course, with our recent weakness that I just got done mentioning on the Dow Jones Industrial Average on the daily charts, that's not doing it any favors here on the weekly charts, in the hopes of having a bullish crossover here in the next week or so. not saying that it's impossible for it to happen. I'm just saying that the chances are getting worse for it to occur, since it's starting to become more of a laggard here just at the time when it almost had a bullish crossover there. And then down below, you'll see that we have the furthest separation between the two lines on the negative side here on the Russell 2000. The lines are pinching, so that's a good sign, right? If you eventually want to be bullish, you want to see those lines eventually pinch, because then eventually they will cross over as well, assuming that there's some strength in the market. But we've had a heck of a run, 40% off of the lows or whatever it's been. And if that's not enough to get a bullish crossover, then it makes you wonder what's it going to take. So at this point, some folks might be wondering, is this a market that's about ready to just kind of take a little bit of a breather, try to catch its breath before its next move? And if that's the case, then you might have to bide your time a bit more on some of those crossover charts that we're looking at there. All right, let's now go ahead and take a look at our 3 green arrows charts. This will be the 4D chart. And here we only have one chart with a signal, and that is the NASDAQ Composite. No surprise there. Again, that's our leadership area. So the NASDAQ Composite, you can see, has this light green background color here on chart 4D. And that signifies 3 green arrows, where we've had the green arrow in place on the 30-day moving average going all the way back to April 7th. We just got our green arrow back today on the MACD histogram there. And then we've had a green arrow here for the last couple of days on that stochastic, as we had a phantom green arrow take place there. So it was as a result of the MACD histogram crossing above that 0 line that gave us that green background color there. So remember, the MACD histogram is going to be a measurement of momentum, and we have seen a nice little burst of momentum in those NASDAQ names, especially in the last 4 days. The other charts have a white background, signifying that you have a mix of green and red arrows, and therefore nothing all that worth reporting to you here in this particular case. All right, let's move on now to our 12 grid analysis, starting with chart 5A. This will be our asset class 12 grid. Remember, the background colors of these miniature charts here will signify whatever the current posture is using the intermediate line on the market forecast technical indicator. So when you see green charts, that means we have bullish postures. When you see the pink charts, that means that we have bearish intermediate postures. There are 2 different shades for each of those colors, signifying either weak bearish versus strong bearish, or weak bullish versus strong bullish. So be aware of that as well. And I actually have examples of all 4 of those shades right here on this 12 grid in front of us. For instance, there's only one light green background color, so I guess we'll start with that. In the lower left-hand corner, you'll see the US dollar right here. We have this light green background color because the intermediate line itself is rising between 20 and 80, but it's not yet crossed above the chart's midpoint at 50. It's only at 35. So we have some initial signs of bullishness there. But you can see when you're looking at the chart, combining your knowledge about the market forecast posture system along with what you can just see visually with the chart itself, that there is some concern about this right now, or at least there would be some concern from my perspective, just because at this point I would say that the path of least resistance continues to be the downside, because we have that strong red moving average, going down at a healthy pace. And the last 3 days, we've seen a couple of tests of that downward trending moving average, and so far it looks like it wants to bounce down and away from it. So I actually don't mind that, and I think some of you are the same way. I'm a cheerleader for a weaker dollar. I don't have any major vacations planned. Probably very few of us do, considering the circumstances of the travel industry right now. But anyway, if you ever want a strong dollar, it's possibly when you're about ready to go on a big trip overseas. As an investor, I more often want a weak dollar. And part of that is because I tend to invest in big blue chip dividend growth companies. Your Procter & Gamble's and Coca-Cola's, those types of companies actually make more money outside of the United States than inside of the United States. So their earnings actually benefit when the dollar is weaker. So a falling dollar can end up being a benefit to stock investors. So when I see something like this, I don't want to make it sound like it's, I'm unpatriotic or anything like that. I just want to see my stocks go up. And if it takes a weaker dollar to do it, then so be it. So You don't want it to, unravel in a hurry because that can cause market dislocations. But if it can be just a smooth glide path lower, that actually helps support a lot of different stock prices, whether you're talking about the big internationals that I talked about a moment ago, or whether you're talking about foreign stocks specifically, like ADRs, right? Nestle and China Mobile and those types of companies. Or whether you're talking about commodities. Usually a weaker US dollar will benefit commodities prices that are priced in US dollars. And that can then, in turn, benefit those commodity producer stocks that are out there as well. So a few things to think about there, but that is our example of a weakly bullish posture. All the other green charts you see on the board are actually strongly bullish postures. It's that deeper shade of green that you see there. So you can see emerging market stocks making that move. I talked about this on Tuesday as well, where this was the one that looked different than the other two. In other words, the S&P 500 and the developed foreign stocks did not look as good to me on Tuesday as the emerging market stocks did. And this has bounced even harder here today. You can see emerging market stocks were up 2.27% today, easily eclipsing the 1.1% move out of the developed foreign stocks and the 0.5% move here in the United States. You'll notice here the positioning of this candle on the chart for EEM is now up here at its highest level. It actually had a closing 3-month high for EEM, just barely getting up and over some of these other candles at the beginning of June. Now notice that in comparison to EFA, which still has its candle close to its moving average, and the same thing goes for the S&P 500 itself. Those charts are not close to where they were trading back in the first week of June. EEM is. Those of you that are not quite as familiar with that terminology, emerging markets tends to mean companies that are still in the developing part of the world. Some people might have referred to them previously as third world countries in some cases. There's different ways to phrase it, but the key countries that you're going to want to know that kind of control a lot of that price action in EEM are going to be your BRIC nations. That's an acronym, BRIC. And that stands for Brazil, Russia, India, and China. So those might be some areas where you can look for some opportunities going forward, because it does look like they're emerging as a leadership area right now compared to the more developed parts of the globe. You can also see that long-term treasuries and foreign bonds continue to have those bullish postures. Of the two, I think I like the foreign bond chart a little bit better than TLT. And then down below, both gold and oil have strongly bullish postures as well. And you don't need me to tell you that I've been a bull on gold, and I continue to be. Now, we did have this overbought cluster signal here, but generally speaking, we've behaved ourselves above a rising moving average, and I still have a rosy outlook for gold, I guess you could say, going forward. And so we'll see if those trades continue to work on our behalf. In terms of the pink charts on the board, I already addressed a couple of them up there at the top with developed foreign stocks and the U.S. stocks. The other pink charts on the board are over here on the right-hand side. We have a light pink color over here with the real estate investment trust. So this is Vanguard's version of that, VNQ. You can see it's that light pink background color, so that signifies weakly bearish posture, so not strongly bearish, but weakly bearish. And that's because its intermediate line is at 51 and falling. Remember, if that were to fall below 50, if it would go down to, let's say, 49 from 51, at that point, the background color would turn that darker shade of pink, and this would be considered strongly bearish. But at this point, it's still kind of given itself a fighting chance. You can see, despite today's pullback in the REITs, we remain above a rising moving average, because there's that moving average color tip there right as a green color. So yes, we had a pullback today, but we are still in position for a potential further bounce under the right types of circumstances next week. So we'll keep our eye on that. Whereas these other three charts that kind of surround it, notice that all three of those have price below their moving averages. Now in two of those charts cases, preferred stocks and high yield bonds, notice that the moving average is yellow. In other words, price is below a rising moving average. So we have another conflicting signal there. Down below here in this chart in the lower right-hand corner, this is the 10-year U.S. Treasury yield. This can be used as a proxy for interest rates. So the 10-year closed at approximately 0.67% here today. Anyway, you can see its difference in that you do have that dark pink shade of background color, and you have a red moving average there. In other words, price is below a falling moving average in that case. So we're kind of at an interesting time now where we have a lot of different charts to look at. This is not one of those moments where all the charts are saying the same thing. We are in a moment where there's a lot of separation that's taking place. Some people might refer to this as a stock picker's market. Basically, when you hear that terminology, it's referring to the fact that you might get value out of picking one stock over another. In some markets, you just pick the market, and the market goes up and every stock goes with it, or what have you. But this is a little bit of a different feeling market to me, where there is some value in active management. Of course, many of you are quite good at that, and if you're not and you want to improve your skills, that's where we would invite you to join David and I here at Market Scholars for our premium and plus classes, where we teach you those trading rooms every single day to help you get better at becoming a self-directed investor, as we have now entered into our third year of operations here. All right, let's go ahead and take a look at our next 12 grid. In this case, it'll be the U.S. sectors 12 grid. And we had some pretty good performance here today, all things considered. There were only two sectors that finished lower today, and those two were communications, which was down 0.33%, and also XLRE, which was down 0.34%. So those two were the only two in the red. The rest were in the green. The biggest movers here today included the materials, which were up 1.88%, and also energy had a nice day of 1.11%. Now, when you look at those two charts, you can see that one clearly looks better than the other, or at least it does to my eye, and our colorful visuals should make it easy for you as well. Of those two charts, I would say materials looks considerably better than energy. Now remember, these are the market cap weighted versions, so this is XLB as in boy versus XLE as in Edward. And of the two, you can see the more consistent upward trajectory there for materials. In fact, this is a kind of a nice little bounce off that moving average. This is the type of behavior we would be seeking out in my Wednesday factor-based swing trading class, where we look for bounces and not breakouts. So this is kind of some good charting behavior right here, where you're seeing it bounce up and off of that rising moving average. On the other hand, energy had a strong day today, up over 1%, but you can see it looks tremendously different. Here you're really struggling, and you've struggled for a couple of weeks below that falling moving average. Initially it wasn't falling, so you had that yellow moving average there, but with enough time spent below the moving average, it's now pulled that moving average lower, and of course you've got that dark pink shade of the background color there telling us that we have a strongly bearish posture on energy as well. So keep your eye on materials for positive or bullish trades going forward, and then look towards energy for potential bearish trades going forward as well. All right, mentioned before that technology is probably our leader in this current time period. You can see technology stocks are up about 34% here over the last 3 months and continue to have that dark green background color combined with a green moving average. That's a pretty strong combination right there. All right, so let's get into our trade application example here for today. And for this, I'm going to come on over here to chart 3A. And I'm going to do another, what I would consider to be highly speculative trade. And so this is similar to the trade that I did 1 week ago on Thursday. And some of you that followed along with that particular trade might recall that it was on INO, and this is Inovio. This is a highly speculative situation where I basically only wanted to be in the trade for a week, and as long as the stock did not fall 50% in 1 week, we were going to make money on that trade. Well, that trade is now done. Remember, normally the stock market or the weekly options contracts will expire on Fridays, but of course tomorrow, in recognition of the 4th of July, there is no trading. So today was the expiration of this week's weekly contract, so this is an official win that we've locked in the books here. And so you can see that we're basically making our $345 here. It's actually $350. It's using the mark price of a half a cent here. That technically will be zero. So basically those contracts will expire worthless, and that $350 is ours, clear and free. So we just received $350 from the stock market because we placed a bet that a stock would not fall 50% in a week. Think about that for a second. So kind of remarkable. Now, it didn't necessarily make it easy on us because the stock did fall tremendously during that week. It just didn't fall 50%. And therefore, it was a smart and wise choice on our part to give us so much wiggle room. Other people would have been selling other puts, perhaps the 25 strike or the 20 strikes or what have you, and those folks would have gotten into some hot water there. But because we chose the $15 strikes, we ended up skirting by without too much difficulty, as our strike price would have been way, way down here. So wanted to bring that up to kind of usher in this next trade, which I also consider quite similar to this situation. In other words, it's not for the faint of heart. These are not blue chip companies. These are highly speculative situations, and you just never know when a stock is going to just fall tremendously in a short period of time. So that's my little warning disclosure there for you. We all know that every trade presents risk, but these ones in particular, you'll want to be mindful of the risk that you are taking. So this next trade that I wanted to bring to your attention is CEMI. This is Chembio Diagnostics. Now, I'll be honest with you. I saw this particular stock flash through my screen some time ago as being part of the Russell 3000 reconstitution that takes place at the end of every June. And this particular stock caught my eye because it was a company that I recognized doing business with. I'm thinking to myself, boy, Chembio, that sounds so familiar. Turns out I actually took one of those coronavirus tests, and it came from this company. And later on, it was discovered that this company's tests could not be relied upon, which of course didn't make me very happy as somebody who paid for one of those tests, but that's besides the point. I wanted to explain that because that is why this stock completely fell off of a map. This was a $10 stock here on June 16th, and then on June 17th, one day later, it was less than $4. So that was an absolute smashing of a stock price. Now this is a 3-month chart we're looking at here. I'm going to scan this out a little bit further to a 6-month time period because I think it can be helpful to kind of set up this trade idea a little bit better as well. So this stock, basically from the lows of March, when many companies were getting hammered, this stock went from about $2.25 all the way up here to $15. That's an astonishing move right there. Now, of course, again, this is highly speculative, penny stock territory that we're dealing with here. But the reason, of course, that the stock went up so tremendously is the prospects of this company being one of the anointed few that was going to be offering these COVID-19 tests that were out there. So this particular company took off like you wouldn't believe and made gobs of money for anybody who took a flyer on it during that time period. Ever since topping out close to about $16 there, however, you had kind of a long slide from about $16 to about $10 there before they pulled the rug out and it went all the way back down here. So you might be wondering, well, if you've had a bad experience with this company, why are you looking at it as a potential bullish trade? Because again, what we'll be looking at here in just a moment is another sold put type of a situation, very similar to Inovio that we did a week ago. Well, here's what kind of caught my eye with this one. It's the idea, there's two different things I wanted to point out. First of all, it was up tremendously today. So it was up 27%. And remember, that was kind of the setup that we had with Inovio as well. When we sold those puts, the stock already took off without it. How I kind of explained it to you is like, have you ever missed a trade and you wanted to turn back time? Here's one way you could do it, by selling a put. So it's kind of interesting from that perspective that we have another, kind of small cap company here involved in the coronavirus in one form or fashion in the healthcare side that today was up tremendously. I don't even know what was up tremendously or why this was up tremendously. I tried to check the news and I didn't really see much, so not sure why it went up 27% today, but it did. Well, this stock, you can see is now, if I were to zoom in, let me zoom in on just this area again real quick. You can see that this stock traded slightly higher than these candles right over here initially after the gap down. Now, in addition to that, the close, while we didn't close at the exact high of today's candle, this close is the highest close of all of those days since that gap down took place as well. So in other words, this could be a gap fill candidate. Now, this would be a very aggressive gap fill, so I don't know if I would be willing to bet the farm on something like that. But for those of you that felt a little bit more bold and speculative, you might look at this as a situation where you put your stop loss a little bit down here, below, let's call it 280 or so, and your upside potential that you're shooting for might be all the way up here, $8 or something like that, right? So that could be a situation where you could double your money if it plays out that way. Now, again, be careful. There's a reason that those things rarely work out. The odds are highly against that type of thing taking place in the near term. But we do have at least some historical information to suggest this is the type of company that could double in a very short period of time if the news flow was good enough. So that was one thing that caught my eye, is that we had this gap down. Normally, the first couple of days after the gap down will be considered the resistance area, and the stock should struggle to get back up above that resistance area. If it does, which is what happened today, then the assumption is, okay, now we might be talking about upside prospects here in a potential gap fill situation. Now, in addition to that, you'll see that we bottomed out here somewhere between 250 and 225 back here in March before taking off as well. So it was kind of interesting that despite this terrible news this company had, it did not breach its prior low. It went down tremendously and really burned a lot of investors at that time, but it did not go below where it was trading over here. So it did not show up on the 52-week lows list. So I think that's a somewhat bullish sign there as well. Another thing that I'll point out is that not only did we get oversold cluster signals that showed up, that's what these little dots are right here, and those occur when we get the blue, the green, and the red lines all in the lower reversal zone at the same time. That's generally known as an oversold signal, where we've gone down in one direction too far too fast, and we might have a chance at a reversion to the mean type of a trade. So some of you might be attracted to that as well. And you'll notice, of course, we had those oversold cluster signals right over here, right before that stock really took off to the upside as well. Not to say that that's going to happen again, but just, again, showing you that there are multiple facets to this trade. And last but not least, you'll also notice that we have what's known as a bearish, or actually a bullish near-term divergence. Now, what that type of a trade is when you look at this blue line, you can see it's a thicker color on this particular chart setup. This is the chart setup I use for my swing trading class. Anyway, you have a low in the blue line deep within that lower reversal zone right here back on about June 19th or thereabouts. You have another low that takes place here on June 29th, and you can clearly see that that second low is higher than that first low. In other words, you got higher lows in that blue line there. Now notice at the same time on the chart, the candle that was associated with the first low was way up here at about 368 or thereabouts, and the candle that was associated with the second low was right here at about 307. So in other words, price went down at a time the underlying indicator went up. That is telling us that below the surface, there's something a little bit more bullish brewing than the price action all by itself would suggest. So there's a lot of different things, a lot of different elements there that you could latch onto. Again, I need to stress that this is a highly speculative stock. Who knows? This stock could go down to $1.50 in a heartbeat, if they were investigated by the feds or something along those lines. So you have to be very careful with these situations, but the technical analysis itself is quite intriguing. So now the question is, how do we take advantage of it? I mentioned before, some of you might just want to buy the stock and use it as a flyer to kind of gun for some of those higher areas that we saw about a month ago. I generally am not a big fan of that, just because I'm not highly confident in this situation where we're dealing with kind of an unknown penny stock situation here. So what I'm going to opt to do instead is another one of those sold put trades, just like I did with Inovio. Now this one is not as good of a setup from that perspective to me. First of all, in Novio, we only had to be it in a week, and the stock just merely had to not fall 50%. That was a pretty darn good setup. What we'll be doing here with Chembio is you'll notice it does not have weekly contracts. So that relegates us at a minimum to go to the July contracts, which expire in 2 weeks, not 1 week like we had with Inovio. In addition to that, this is not anywhere nearly as liquid as Inovio, and therefore we don't have penny increments on the options contracts. We're moving in nickel increments right here. And you can see that currently the $2.50 put is trading at 5 cents on the bid, 10 cents on the ask. Now that is still a 3% return on risk. Remember what I said a week ago when I was doing this presentation. When I'm usually teaching these in my premium classes, we're just looking for a 1% return on risk. So this is like 3 times better than what I would naturally get if we were able to get, you know, somewhere between 5 and 10 cents. Of course, we would be forced to get 5 cents if we force the trade through immediately here. But if you were to get 10 cents, you would have a slightly higher than 3% return on risk. So in other words, this is a good acceptable risk here. And if the stock were to fall from $4.18 where it currently is all the way down to $2.50 in the next 15 days, that's a drop of 40%. Again, it's not quite as good as what we had with Inovio, where it had to fall more than 50% in 1 week. This is, it has to fall 40% in 2 weeks. So there is more of that possibility for risk to creep into the system and blow up our trade. So we've got to be mindful of that. But you did have 600 contracts traded here today in the volume, and you have over 1,300 or around 1,300 in open interest. Here's what was kind of weird about this situation. You'll notice that the last traded price for that contract was actually 15 cents. I really wish we could get that number. I don't think we'll be that lucky. Right now, again, the bid is 5 and the ask is 10. So how they got that filled at 15 cents, and I checked that trade, it was actually within the last hour of the day. So whoever got filled at 15 cents should feel pretty good about their fill price there. We are probably not going to get that lucky. So then the question has to become, do we want to accept the 5 cents, which strictly on a percentage basis I'm comfortable with? Here's what I don't like about that situation. I don't like feeling like I got locked into a trade. When we're dealing with nickel increments like we are here, we can't buy this back at zero, right? It's either, if you're going to get out of your trade after you got into it, you're going to have to buy it back at a minimum of 5 cents. And if you only got 5 cents when you sold it to begin with, there is no chance that you can make money on that if you need for some reason to get out in the 2 weeks ahead of time. So if you're taking the nickel there, you're basically saying, I'm riding this thing until expiration. Otherwise, there's no chance I can make money. So I don't necessarily like that. Ideally, I'd like to get filled at 10 cents. That gives us a little bit more flexibility where if for some reason we needed to free up buying power or whatever other reason, we could try to get out by buying it back at 5 cents. Sell at 10, buy it back at 5 if we needed to. Now that wouldn't be my original goal. My original goal would be to get filled at 10 and to hold that till expiration, but I just don't like feeling trapped. And sometimes when you're selling at the 5 cent level on nickel increment stocks, you feel trapped. So I think what I'm going to do in this case is I'm going to try to get filled at 10 cents. And there's a chance we can do it because, again, the last traded price is 15. So 10 should not be out of the realm of possibility. But given the fact that right now the ask is 10, this is far from a sure thing that will actually get filled there. Now remember, a lot can happen here over a holiday weekend. Who knows what happens with the coronavirus, this, that, and the other thing. So maybe we open Monday morning with a big gap down in the stock market. And if that's the case, then we stand a better chance to get filled at 10. But I just want to point that out because I think what I'm going to do for the trade application example here is put this in as a good till cancel order to get it filled at 10 cents. That sets up the possibility that we just don't get filled, and you have to be comfortable with that. If you are hell-bent on wanting to get filled on this trade, then you would have to get filled at 5 cents. And so your rewards would not be as good in a situation like that. So I'm just pointing that out in case some of you want to handle your paper trades a little different than how I'm doing it right here. So in order to place that trade, I'm just going to click on the bid price here. And that's going to load up our trade down below. In this case, because it's a really tiny price stock, I'm going to do 10 contracts here, and I'm going to try to get 10 cents on that trade. And I am going to put this in as good till cancel, and that way if I don't get filled on Monday, but the stock falls on Tuesday pretty significantly, and my order's there waiting at 10 cents, I'll be happy to take it at that point. So if I click on confirm and send, you can see this is a situation where approximately $100 minus any fees that you have to pay for commission or anything like that, but approximately $100 comes into our account for placing a bet that says, we don't think this stock is going to fall 40% in 2 weeks. So again, highly speculative. This is not Procter & Gamble we're dealing with here. But if you believe that a stock stands a better chance than not of not falling 40% in 2 weeks, then perhaps this is $100 that can come into your account. Now remember, if it were to fall 40% in 2 weeks, then you have to be on the hook for buying, in this case, 1,000 shares of this company at $2.50 since we're doing 10 contracts. So you would have to spend $2,400 in order to tap into that. For many of you, that's perfectly fine. And I think it's fine in this case as well. That's actually a very small trade for our purposes of what we normally would do in this video. So I'm comfortable with that, but just pointing that out to make sure all of you are as well. So let's go ahead and send that in, and we'll see if we can get filled on that either Monday or Tuesday or sometime next week. All right, well, I want to thank you for joining me here. I didn't realize this video was going to be as long as it was, so I apologize for the length, but hopefully you got some benefit out of the additional details there. We did have a lot of differences in the various charts we were looking at here tonight, so I wanted to help explain that to those of you, especially those of you that are a little bit newer. But I want to wish you all a very happy holiday weekend. Enjoy your time with your friends and your loved ones, even if it means being 6 feet away from them and wearing masks. Try to be careful with those fireworks if you're lighting them. Here in my neck of the woods, we actually had some fires here a couple of days back because of fireworks, so I'm speaking from firsthand knowledge there. It's not worth burning down your neighborhood to have a little bit of fun, but hopefully one way or another you get a chance to kick back and relax. Enjoy the celebrations this weekend. Feel refreshed and recharged and ready to tackle the markets starting next week. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.